Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Irimat, and Karunya Rao should be with us in just a few. Let's begin with the headlines. This morning, there's been a sharp rebound. Nifty is surging above 11,800, and we have the FMCG stocks which are really leading the run this morning. Next up, we have a top gainer on the anvil. We have Kotak Mahindra Bank, strong earnings, brokerage upgrades pouring in for this one. JP Morgan particularly overweight on the stock with a target of nearly 1600 rupees per share. We then have some more earnings cheer. We have Angel Broking currently at 290, up 16% on the back of a highest ever quarterly profit in Q2. And that's got the low-cost broking model in focus as well this morning. We then have a bunch of earnings candidates that we need to look out for. Airtel, Tata Motors, CEAT, ICICI Pru, Amara Raja Batteries, all will be reporting their earnings today. So keep your eyes out on those counters as well. Finally, an all-important defense deal currently underway. India and the US to sign the last foundational agreement for the BECA. The BECA stands for the Basic Exchange and Cooperation Agreement. The BECA will lay the foundation for deeper military cooperation in future and to take place in the third 2+2 meet. That was the headlines for this morning. Let's now take a look at the quiz question we had for you and how well you know the markets in our BNSN Quiz Connect segment that we've been doing every day. Our question to you today is, which of the following insurance companies have the highest margins? Your options are all leaders from the respective field: SBI Life, HDFC Life, ICICI Lombard and GIC. These are your four options. Please tweet to us on the ET Now handle, and if you get the answer correct, you will be featured on the TV screen at 11:45 a.m. this morning, which is in about 40 minutes from now. Now, in the meanwhile, let's take a quick look at the markets and see how they're faring. There's been a rebound, like I said, so Nifty is up nearly 0.5%. The mid-cap index is up 0.53%. The auto index is up 0.72%. And Kotak Mahindra leading the bank Nifty charge up 1.29%. Now, Kotak Mahindra is currently up 10%, so what a move seen in this one today. On the back of that, you also have Nestle not too far behind, 4.5% up. You have a Shri Cement gaining 4.5%. You have an Asian Paints up nearly 4%. NTPC, not too usually making it into the top gainers list. That's also up nearly 4% this morning. On the losing side, we have two IT stocks, Infosys and Wipro, both down 2%. We have Adani Ports down nearly 3%. We have GAIL down nearly 2%, and ONGC down nearly 2% as well. So the market breadth still remains in favor, 33 stocks advancing versus 17 declining. So that's a good measure of what the overall sentiment on the street is. And that was a quick little rundown on the market for you. With that, I think it's now ready, or rather it's time to take it to our experts who are with us, both Kunal Bothra and Ashish Maheshwari. Good morning, and thank you to you both for joining in as always. Great to get perspective from you. Kunal, coming to you first. Despite the fact that we've had a weak global handover, our markets are staying in the green today. Is that because we fell a lot last afternoon, or is that because stocks like Kotak Mahindra and Nestle are really leading the charge today? And also, what are your calls today for our investors, high risk and low risk?
So, good morning, Varun. Yes, I believe a part of the rebound today is more of factoring in what could have transpired yesterday for the global markets. I think our markets tend to have that quality or characteristic to sort of factor in what could happen across the globe, and then we tend to outperform or underperform depending on the kind of trend. So I think a part of that could be attributed towards that. The other part could be I think majorly towards the rise on Kotak Bank, because if you look at the price performance for Nifty and Bank Nifty, Nifty is up 0.2, 0.3%, but the Bank Nifty is up more than 1%. Now, when you have such kind of a disparity in terms of price performance, you generally attribute to that towards maybe an underperformance towards one sector or an outperformance towards one sector. So today, the Nifty IT index, for example, I think is down some 1.5 or 2%. You have the stocks like Kotak Bank, which is outperforming. So the markets are trying to just about play a balancing effect over here, and I think this is likely going to be the texture for the markets overall. But net, I believe that we are still consolidating on the indices. We are going through a broad consolidation, 11,600 as a major support for the index. The near term, 12,000, 12,040 has been a series of multiple resistance for the Nifty. So I think till the time we don't break this band, it's likely to be such kind of a mixed sector outlook in terms of the indices and the market structures. Now, two calls which I would initiate at this level. One of them is a low risk category. It's a buy on Tata Consumer. Would suggest a buy with a short term target of 505, 510. Stop loss could be kept at approximately at 480 levels. And the second would be a buy on a high risk trade. It's a buy on L&T Housing Finance. Now, it's interesting because many of these housing finance stocks, have started to move up higher. You saw Bajaj Finance, Shriram Transport, Chola Finance, many of these other names, whether it's HFC, whether it's the NBFCs, etc. These pockets are now trying to pick up pace. I believe eventually even L&T Housing Finance, which is on the verge of a breakout of a multi-swing resistance. I think even this stock would probably try and play a strong catch-up. So in the anticipation of a breakout, I would suggest a buy on L&T Housing Finance, short-term targets of 72, stop loss at 63.
Okay. Ashish, what are your fundamental calls from a high risk standpoint and the ones with a low risk format?
Yes. In high risk format, I like IFB Industries. Though stock is touching their 52-week high, but in my view, there's still a big valuation gap between Whirlpool and IFB. Whirlpool is available at 26,000 crore market cap, and it is just quoting at 3,000 crore market cap. We see hardly any floating stock is there because 75% of this company is owned by promoters and around 15% is held by institutions. So hardly 10% floating stock. The game changer is in the last quarter, we are going to see very big jump in the sales of their all product lines, be it laundry or kitchen or living space. There's good demand coming from offline and online both format. So this is the reason why I've selected IFB Industries. On 30th October, they are going to come out with results. And after reporting losses in last two quarters, this quarter they are going to be in green once again. So IFB Industries is a 1 year buy with a price target of 1,000 rupees. Another idea which I like in the low risk is Just Dial. Again, the valuation gap between India Mart, which is almost 14,000 crore market cap, and this company is just 4,000 crore market cap, is again big. And they're just doing exactly same what India Mart is doing. Plus, what they have done, they have brought all the unicorn models, be it Make My Trip or Swiggy or Urban Company, everything on their one platform. Another thing what they did is from B2B segment, they are just now tapping all the shops which are in a city's vicinity. So they are going to have good revenue on. If we see even March to June quarter, they have reported net profit rise from 76 crore to almost 84 crores. So in my view, this quarter is again going to be good for companies like India Mart and Just Dial. That is why I've selected Just Dial as a low risk investment at this point of time.
All right. Thanks for your picks as well. Slipping into a break here, but on the other side, we'll be addressing our viewer queries. And if you're watching the show and if you have any queries, questions or concerns with regard to your investments or potential stocks that you'd like to invest in, do write to us on Twitter and you can also email to us. Thank you so much, both of you. Please hold on. We'll be back and we'll address our viewer queries on the other side of the break. Welcome back. You're still watching Buy Now, Sell Now. Time to address our viewer queries. First up is an email from Rishabh Parikh. He is based in Pune and he wants to ask our experts whether it's a good idea to invest in angel broking following the stellar set of numbers that they've reported. Kunal, coming first to you on angel broking. We've seen first a stellar listing for the company. Yes, there have been some ups and downs in the last couple of months for the stock as well, ever since it got listed, couple of weeks actually to be precise. But given this 16-17% uptake that has already been factored in today, would you suggest a buy or should he wait for dips?
I think it's too early for me to frankly comment. Karunya, I think it's just about 3 weeks of data for a stock like Angel Broking. Hardly any major volume triggers which you've seen. I think except for today, there's hardly been any major volume activity. The stock was from 280 to 90 levels, it corrected to sub 230 levels, and now back towards that 290 plus mark. So I think in terms of trends as well, it's just about in the nascent stages for me to really comment on it from long term. So I think except from a short term view, which indicates that the stock is in the thick of momentum. If you're looking to buy, then probably I can advise you, a stop loss which is closer to today's gap. I think around 260 mark. That could be a prudent short term stop loss. But again, I think more the more the data points, the more the price candles which we see, the more stronger and robust our view is. So I think because of the lack of data points, it becomes very difficult to give you a medium term to long term view. I think best is what you can look to buy. If you're looking to buy the stock, then I believe keep 260 as a kind of a stop loss trade, and then look to hold on to the stock.
Okay, thanks for that, Kunal. Ashish, coming to you, Angel Broking is a hybrid model. So they have free brokerage, which is zero fee brokerage for their premium customers. For new customers like you and me, they have 30-day free trading, and then it's also a lower fee as compared to a Motilal or ICICI, is what I understand. They also now have 8% market share. Just to give you an idea of the size there, 8%, Kotak is like 1.5% market share. So although there's limited operating history, what's your view on these kind of brokerages? The numbers which came yesterday are phenomenal.
Yes. In fact, last quarter was pretty good for all the brokerages because markets has given good bounce back at the same time as people are at home, so they are mostly intelligent to trading, etc. But in my view, same trend may not continue first of all in going quarters. So their numbers were good, but only one challenge is that IPO came at 306, and from that point of time, only investors not got opportunity to exit. So those investors who are waiting to exit, they will surely try to exit somewhere near to the IPO price. So, like if anybody want to buy this stock, in my view, let's wait for some more correction. Again, 230, 240 will be a good entry point once again whenever market falls and we get at that price. So my suggestion will be to exit at this point of time from angel broking and try to only enter at lower price.
Okay, great, Ashish. Thanks for that. Let's move on to our next query then. By the way, both our experts basically are saying that you should look at a lower entry price for angel broking. At the current price, you can stay away. Let's move on to Kotak Bank. We're also going to bring you some brokerage upgrades on that in just a minute. But we have Ashok Patel from Surat writing to us. He wanted to buy Kotak Mahindra Bank yesterday post those numbers coming out. Now today, when the stock is up 10%, he's a bit apprehensive. He's saying, should I buy today or wait for a correction? So Kunal, coming back to you first, that chart on Kotak, does it look like it's going to give you a better entry point anytime in the near future?
Well, very difficult to anticipate that whether you get the entry point better or not. And I think I've realized in trading that you can't buy at a stock at a perfect price. You generally arrive at a perfect price if you want to buy, and that you generally do it either by trading or trying to buy in stages. Depending on the case, depending on the scenario for each stock, etc. So for Kotak Bank as well, yes, the stock has today moved up almost 10% higher, and that's one of the sole reasons why the Bank Nifty is also charged up, particularly. Now, this is a sign of a strength for Kotak Bank. When you generally see a stock which is leading the charge for the banking index, there is a tendency of this stock to outperform. So even if the bank Nifty remains a bit muted, it's possible that Kotak Bank can continue to outperform. Remember that today the stock opened up at 1460, 1465 kind of levels, and from there on it just about went higher and higher. So the average buying price for the investors would have bought post result would be about or very close to the 1500 mark. So if you can if you have a buffer or if you have a cushion, then I believe you should start buying at current levels, and probably if the stock provides you any kind of opportunity around the 1500 mark, look to add further, because I think that's where the VWAP price, or that's where the weighted average price would be for the stock price. So keeping 1500 as a pivot point, I think you should look to buy even at current levels.
All right. Okay. What is your sense on Kotak, Ashish? Several brokerages have given the numbers a thumbs up. Would you concur with them?
Yes, in fact, their Q2 numbers were much better than the peer set so far. But again, one apprehension is that the credit growth is again slowing down for them also. I think only the home loan and LAP related portfolio is going up, but this is not something where you make big money. You make big money when you lend to corporates where yields are better. So my view is that already stock has appreciated by almost 150, 60 rupees in the last couple of days. So this is not a good entry point as far as Kotak Bank is concerned. In my view, 1475, 1480 is an apt level to look at this stock. So wait for some correction, then only you enter. Don't try to buy at the top.
So Ashish is quite clear. He likes the result. A very strong result from Kotak Mahindra Bank, but still he believes that due to credit growth slowing, you might get a better entry point. So I hope you heard that to our viewer. On that note, a big thank you to both our experts for tuning in this morning. Appreciate it. Let's get a move on and get you some house views on Kotak Mahindra Bank. We actually just have one that we'd like to flag off to you because we believe it encapsulates everything quite well. That's JP Morgan's note, and their target is 1575, so just shy of 1600 rupees. Seems that we're going to get there today itself already, the way Kotak Bank has rallied. According to them, on the flip side to what Ashish was just saying, they feel that the bank is getting back into growth mode. The liability build-out remains exceptional. So your deposit base, which is now like 2,60,000-70,000 crore, they like that. Expect to come back into lending mode. So the credit growth, capital is available. They also did a $1 billion QIP, so that's not going to be an issue for them. And the collection rates have improved. That's what JP Morgan really likes, which basically means the credit cost is very low. The brokerage poll indicated a 150 bips credit cost. Kotak Bank came in at 70-80 bips. So that's just quite outstanding. So good, strong performance from them. After the result, we at ET Now caught up with the management. And, they walked us through the key highlights in their view, what they thought was important. Let's listen into a couple excerpts from that conversation.
From what we saw in the April-June quarter, it's a 36% growth of the April-June quarter. Distribution income, which consists of things like distribution of mutual funds, insurance, and third-party products, that showed almost a 50% jump on a year-on-year basis, and we did about 172 crores of distribution income this quarter. The rest of the fees and services, which comprises largely our general banking fees, that is still lower than last year, signifying that there are still volumes to be picked up. And a lot of things which are linked to volumes and activity are decently higher than the April-June quarter. In fact, the general banking fees is 40% higher on a quarter-on-quarter basis, but still short of the year-on-year numbers. The other than fees and services, what constitutes other income, we did 394 crores this quarter, as against 62 crores in the previous year, the same quarter. It was helped to some extent by the fact that we had decent recovery on stressed asset buyout. As you all are aware, we are players where we acquire stressed assets and we do resolution. So we had good recoveries in that segment this quarter. We have also got decent profits, which came in from the non-SLR securities, including equity investments. And some benefit which we got on sale of some premises, which we did in the current quarter. So that helped the other income, which is the non-fees part of the other income in this quarter.
Let's also listen to S. Narain of ICICI Prudential AMC, where he talks about how markets have performed in greed and fear cycles and the next big theme to watch post-COVID era.
See, markets were always right, then there would not be any requirement of active fund management. So in 1999, you could have bet on all the IPOs which came out in America. In 2007, you could have bet on all the road IPOs, construction IPOs which came out in India, and all the power IPOs which came out in India. So markets are not always right. Markets are sometimes right, sometimes wrong. And what happens is periodically you have bubbles in different sectors and you have extreme valuation in certain sectors and they go down. So if you had met anyone in the 2010 to 13 phase, I used to tell them, how can you be buying in real estate in India? They used to say, India has a massive demographic dividend, so real estate prices can never but go up. In 2020, after 7 no-return years in real estate, now people are shazen. Maybe now real estate is much better as an asset class, but there was always demographic benefit in India. But why is it for 7 years real estate didn't go up in India? So I think markets are not always right. Markets go through these greed and fear cycles. So if someone comes and tells me there is a share which is very, very attractive and there is no one willing to buy it, it interests me, because in 2001, 2, 3, after my education, I spent 7 years, more than 12 years, and I realized that people said equities is a hopeless asset class. And I used to think that equities is such a great asset class because dividend yields were so high in 2001 to 3 compared to fixed deposits. Price to earnings used to be so cheap, and people used to say equities is a useless asset class. But I used to think that is why the asset class is very, very attractive. Today, I find people, today you take the month of October, power demand has been good, coal dispatch has been good. People say these are not growth sectors. Everyone says dishwasher is getting sold, fans are getting sold. If you look at most of the consumer durable results, it shows that consumer durable sector is booming. But consumer durables, whether it is fan, air conditioner, dishwasher, vacuum cleaner, they will all work without power demand, without power. And that is the beauty. So people say power will not grow, but all these will grow. So that is the advantage for all of us in the sector.
Slipping into a break here, more updates when we come back. Stay tuned.
Hello and welcome back to Buy Now, Sell Now here on ET Now. Very important development, MSCI rejig. Going to be a lot of increased inflows for Indian equities from the November series. It's a welcome gesture as far as the markets are concerned. But my colleague Vivek is going to walk us through the fine print. Over to you, Vivek.
Well, an extremely important and a very significant and a positive development that has occurred overnight as far as the entire Indian equity market is concerned. So now what has happened is that first you need to remember that NSDL as well as CDSL went ahead and updated on time the foreign ownership limit in all of the Indian equities, and this was something that was done in order to enable both of the market index providers, number one MSCI and number two FTSE, so to implement changes in the foreign ownership limit in the MSCI as well as the FTSE global indices. So now what has happened is that remember FTSE already said that they would be considering and implementing this particular development in 4 subsequent quarterly reviews. What MSCI done is that it's very positive, and remember MSCI has a much larger passive equity inflow base compared to FTSE. What MSCI is doing is that they're implementing the change in the foreign ownership limit in the MSCI global indices containing Indian securities, and the entire FOL would be done in one shot on November 30, 2020, and all the changes would be effective from December 1st, 2020. So now mainly the reason why they have done it in this particular review is that they have actually been satisfied by the recent disclosure of the FOL, the foreign ownership limit for Indian securities by NSDL and CDSL, and what they are saying is that as far as the entire development is concerned, they will actually be they are satisfied with the concerns being addressed on timeliness, quality and standardization of data. So what does this mean for India? It basically means a very large quantum of passive money would be flowing into Indian equities. Remember, a whole host of brokerages had pegged that as soon as the investability factor increases, India could witness anywhere between $3 to $4 billion of inflows just on the basis of MSCI weight increase. A lot of stocks will be in focus. Kotak, L&T, Colgate, Britannia, Nestle, all of them would see weight increases.
Thanks, Vivek, for getting us that important update. Clearly a welcome move from a market standpoint. Pulling up the BNSN stock cloud real quick and telling you what are the stocks you need to keep on your watch list in today's session. Starting with the NTPC, an important one to watch out for, and even though the market was trading lackluster earlier on, NTPC continues to soar. In fact, it's up almost 4% in trade today. So good gains coming in as far as NTPC is concerned, they're looking to consider a share buyback as well. So all eyes on that development now. Talking about some earnings candidates, you have Angel Broking in the fast lane, actually soaring in trade. Fast lane would be an understatement. You have Finolex Industries, Kotak Mahindra Bank as well, reacting quite sharply to better than expected numbers and good brokerage reactions coming in. ICICI Prudential as well, another stock to keep on your radar as far as earnings are concerned. Meanwhile, you have defense stocks, Midhani, BEL, BEML, the likes of L&T. These are the ones which are in focus. India and US are looking to ink a landmark defense pact during the talks that are still underway. So an important event to watch out for, on the back of which these defense stocks also very much in focus. Some brokerage notes coming in. First up, you have Aurobindo. JP Morgan continues to be overweight. They've given a 950 rupees target. Natural investment, or rather divestment, turns balance sheet to net cash, which is a positive. Meanwhile, Persistent looking pretty weak. Citi maintains a sell, target at 1155. Meanwhile, you also have a Torrent Pharma, which came out with its numbers yesterday. Brokerages are giving it a positive response. CLSA maintains a buy. Portfolio mix augurs well for healthy earnings growth. India growth has been ahead of the industry, so quite a few positives, and Torrent's India positioning, of course, remains attractive to many of these brokerages. Moving on to earnings that are expected today, all eyes on Tata Motors. They will be delivering their Q1 report card, and it's after Bajaj Auto, you have Tata Motors, which will be representing the PVs and CV side, especially JLR, how that turns out. So lots to watch as far as this one is concerned. For consolidated numbers, we're looking at revenues of 49,000 crores, loss seen at 2,300 crores, EBITDA close to 3,800 crores. Margin, while on a YOY basis, it's likely to contract 300 basis points. But if you look at the way things have played out in the last 2 quarters for Tata Motors, a 7.8% margin is actually a very significant sequential improvement from 2.1% in Q1 to 7.8% now. Of course, Q1 was a very, very rare situation given the lockdown woes, not just in India but in key global markets as well. So yes, sequential improvement seen across the board. India business is likely to be weak because of subdued CV demand. JLR improvement mix is likely to augur well for the company. Higher share of LR. China has seen a robust improvement. Cost-cutting benefits also likely to work well for the company. For JLR, we're expecting revenues of close to 4.3 billion pounds with adjusted margins of 6.5%. Margin loss to come down because of stable commodity, operating leverage benefit, cost control measures. We're expecting JLR to also report a loss of close to 200 million pounds. Let's see how things play out. Lots to watch out for in terms of discounting trends, demand and inventory situation globally also for JLR, and locally how things are panning out for the India business, PV and CV both. What's the update on business turnaround strategy, their capex and R&D spends? So like I said, all eyes on Tata Motors, an important one to watch out for.
Right. There's also Airtel, which we need to look out for. They've improved their ARPU the most in the last 8 quarters, so people are hoping that that trajectory will also continue. But my colleague Sunita Nagpal is now here to walk us through all the important information regarding this result. Let's listen in.
We are expecting growth to continue for Bharti Airtel in second quarter. This is largely with the economy unlocking. We are expecting subscriber base to improve. As we saw when the COVID had hit, there were some subscribers who were not recharging, but we are expecting them to come back. And as a result, we are expecting subscriber base to increase by 0.6%. ARPUs, which is average revenue per user, is also expected to improve in this quarter. We are expecting it to come at 160 rupees versus 157 in the previous quarter. We are also expecting higher contribution from the enterprise side business as well as broadband. Margins, we are expecting margins to remain almost stable at the previous quarter levels. There will be a 3% growth in EBITDA. Bottom line is always difficult to predict in case of Bharti Airtel because there are always extraordinary items, but this time we are expecting a marginal net profit of 120 crore rupees versus a loss of 15,000 crore rupees in previous quarter. But it's the commentary that will hold how the stock moves on from here. We are expecting management to give some kind of commentary as far as heightened competition is concerned in postpaid, whether they are seeing any initial kind of hits, whether they're planning to match the plans which their peers are offering, whether this means that there will be no tariff hike as we were expecting earlier, what are their expectations on the timeline or the pricing as far as the spectrum auction is concerned.
Thanks for that, Sunita. On to another ET Now exclusive. First to break this story, my colleague Nayantara Rai. The Singapore Arbitrational Centre has passed an interim order asking Future Group to put its plans of selling the business to Reliance on hold. Who thought that a Singapore entity even had any jurisdiction here in India? But apparently they do. The battle is really heating up, and Future and Reliance are trying to push the deal through while Amazon is trying to block it. So let's go across to Nayantara now for the latest twist in this tale. Over to you, Nayantara.
What we had seen was, since the weekend is an interim arbitration ruling, and then both Reliance as well as Future Group saying that the interim ruling is not enforceable in India. They will continue with the transaction as proposed. And without any delay. I then reached out to my sources in the Amazon camp who've gone on to say that first of all the arbitration happened in Singapore only because that it's mentioned in their contract with Future as the only dispute resolution mechanism, and therefore that's why first of all the arbitration took place in Singapore. They then go on to highlight of the various examples of arbitrations in Singapore which have been enforced in India, for example the famous Daiichi case. But having said that, from the market's perspective, this was an overhang that we saw yesterday on the stocks concerned. For example, even Reliance Industries. Just to remind our viewers, the Future Group has a debt of over 12,000 crore rupees. So what is going to be the way out? Right now, the approval is pending before the Competition Commission of India for this transaction. It's a slump deal. So once the approvals and the regulators come in, only then can the deal really close. So you are anyway a couple of months away. Until then, the entire process in Singapore has not been exhausted. This is just one part, the first emergency hearing. Are we going to see more hearings in Singapore? Will we see any of the parties moving the Indian courts? So the battle is here. It's got very, very big names involved. You're talking about big bucks over here. But I think all the camps are also figuring out their legal strategy and the next steps. And I think that's an important message also to the markets.
Okay, well, time for a quick break here. We'll be back shortly. Stay tuned.
Welcome back. You're still watching Buy Now Sell Now. It's time to reveal the answer for today's quiz question. And today morning we asked you, which of the following insurance companies has the highest margins? Options being SBI Life, HDFC Life, ICICI Lombard and GIC. The correct answer to this question, well, it is HDFC Life. And we have one quiz champion for the day who has correctly answered the question before 11:45 on the clock. His name is Milind Karur. Thank you so much and congratulations for getting it right, Milind. And I hope everybody else also had fun participating in the quiz question. Moving on to Times Now Network, which has always worked to keep the interests of you, our viewers, at the forefront. And taking that step ahead, we've launched a special investor awareness series called Nivesh Ke Fande to guide you on managing your personal finances better. Today, we're looking at a very important aspect of personal finance. It's asset allocation, what it means, how important it is. Let's find out.
Today we're talking about asset allocation and diversification. It's actually a crucial part of managing one's finances, but one that's often overlooked.
You're right. And while mutual funds are a great vehicle to achieve optimum asset allocation, one particular type of fund is more ideal.
You mean the multi-asset funds, right? These funds are incredibly efficient for an investor to manage their assets because they allow investments into mixed assets like debt, equities, cash, gold, and so on.
Yes, Abha. And the biggest plus point is the seamless asset allocation composition between the different asset classes, depending, of course, on the market situation.
Yes, exactly. Most investors prefer to invest in limited asset buckets because they're either comfortable with those assets or they feel those assets are the ones that will give them best returns over a period of time.
But you know, the performance of asset classes as well rotates. It rarely happens that one particular asset class consistently tops the charts every year.
Exactly why ensuring diversification in your asset allocation is incredibly important.
And as the age-old saying goes, don't put all your eggs in one basket. That's all on this edition of Nivesh Ke Funday. Do stay tuned for many more such investment insights on the Times Network.
All right, that was Nivesh Ke Funday. Hope you're enjoying those. But switching gears quickly, Walmart-owned Flipkart Group is estimated to have clocked more than double the sales of arch-rival Amazon in the first week of the online festive sale, according to data from Redseer. Chandra R. Srikant caught up with Redseer's Mrigank Gutgutia. Here's an excerpt.
Sure. So I think it's a very important question. And I think the right way to answer this question is to look at how the overall industry shaped up and then think about how the players managed to capitalize on the existing industry trends. So I think one of the biggest trends that we have seen for this festive season is the absolutely massive growth in the total number of online shoppers who have transacted online. So for example, last year we had about 28 million consumers coming in the first week. This year we have about more than 50 million actually. So it's greater than 80% year-on-year growth in the total number of shoppers. So that's one point, right? The second point is that almost 55-57% of these shoppers have come from tier 2 markets. Now that's a customer cohort or a customer group which has very, very different needs in terms of the online shopping experience, in terms of the products they buy, the discounts they look at. What we have seen that a platform like Flipkart has been able to do is to be able to really capitalize on this emerging tier 2 wave of consumers. And it's not like something they have suddenly done out of the blue. Historically, we know the story that Flipkart is fairly strong in the tier 2 customer cohort versus Amazon is generally more dominant in the metro cities. That's been the historical trend over the last few years. But essentially in 2020, as we stand, I think this is the year where a lot of the tier 2 consumers are actively looking to become online shoppers because offline is shut down. Maybe online has potentially better offers, deals. There are a lot of good selection online. So this is the right year for tier 2 shoppers to come online in a big way. And since Flipkart has already been positioning itself to cater to this mass of the population even before 2020, I think they were able to really leverage their existing strengths in this.
Okay, with that, we've completely run out of time on this edition of Buy Now, Sell Now. We're going to wrap it up. Thank you for tuning in.